Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for another after-hour show. I'm glad you're here with me. We had another mixed day on the markets, which we kind of anticipated this happening because of the FOMC meeting that's going on with the Fed. And what is their big announcement going to be tomorrow afternoon? That should shape the markets for the rest of this week and potentially for the rest of this year as we close out December in 2021. So we'll have to see what they're going to say. But investors are definitely anxiously awaiting, I should say, what their decision is going to be. Are they going to speed up tapering because inflation is high, or are they going to do what? We don't know. So everybody is kind of on edge. Some profit taking is occurring in certain sectors. Other sectors are just getting beat up. Technology got beat up today. Solar got beat up today. And we'll go into why in just a moment. But remember, the most important thing, the reason we have this live stream is what's on your mind. If you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. So don't be afraid to ask a question. Any question is allowed on our live stream. So thank you again for being here, and we'll go ahead and jump right into this. So stocks did extend losses today for the second consecutive session. The Dow Jones lost 106 points. It was worse than that today, if you can believe it or not. The S&P 500, that was down as much as 0.7%. The Russell 2000, it was down 1%, and the NASDAQ dropped 1.1% as tech stocks got pummeled on prospects of higher rates. Now, we talked about this during yesterday's live stream about why tech stocks and growth stocks in particular get hurt during high interest rate environments. So we won't hash that out again today, of course, unless that's what you want to talk about. We can. But we did talk about that yesterday. And of course, voila, tech stocks still got hurt today, along with many growth stocks as well. But investors remained cautious ahead of the highly anticipated U.S. Federal Reserve's policy statement due out tomorrow. Meanwhile, data did show that the U.S. producer prices came in hotter than expected, rising to 9.6% year over year in November. That's the highest level in over 13 years, so nearly 10%. And that's input cost for producers. What are the raw materials costing us to make certain things, right? So that was up nearly 10% in a over 13-year high. Now, the hot inflation report may have put additional pressure on the Fed to announce a faster tapering plan and signal a more hawkish rate path tomorrow. But again, we can only wait and see, right? But tomorrow's the big day. Whatever they decide, I just say this, just tell us, right? Give us a timeline right now so we can all just relax a little bit. Now, among stocks, Tesla fell after CEO Elon Musk announced that he had sold another $906.5 million in shares. While Ford was also under pressure as Toyota said it would be investing $35 billion into battery-powered electric vehicles. And that's a bit of a strategy change for Toyota, because they've always been, forget the EVs, we're just going to do hybrids, right? Well, now $35 billion says otherwise to every other major automaker attempting to get in the arena to beat Tesla at electric vehicles. I don't see it happening, not one bit, but it's okay. Tesla can remain the market leader, and there can still be another 2 or 3 other companies that come out to be winners as well in the whole electric vehicle race, right? If you go back 100 years, how many automakers were there in the world? Over 100, right? And it got whittled down to a handful of automakers like GM, Ford, Toyota, right? Those are the big ones. So it's okay that these other companies are entering the market. I don't put any faith in that any of them are going to beat Tesla. Okay. So don't worry about that. Now, the market appeared concerned about the implications of a more aggressive Fed and what the global growth rate will be despite COVID still disrupting supply chains, right? And contributing to restrictive policies that weighed on investors again today. Reports indicate that companies in a manufacturing hub in China suspended operations because of an outbreak in cases. So if we're having manufacturing, I lost my word there for a moment. Excuse me. This is, live stream. I always get stumbled at some point during it. But if a manufacturing hub is shut down, that's just going to cause more pain in the supply chain, right? Because whenever you have a weak link in your supply chain, it can cause pain. And if a whole hub of manufacturers are being shut down, then that's going to delay products from being shipped. And then, of course, once they get shipped, the whole rest of the supply chain is in chaos right now. So that's not going to help. Now, while the market eased off intraday lows this afternoon, 10 of the 11 S&P 500 sectors still closed lower. The information technology sector was down 1.6%, led by a retreat, and featured influential weakness in Apple. Apple was down. Microsoft, it was weak today too. And Adobe, surprisingly, came out of nowhere. That thing was down, I believe, 7% at one point. We're going to look at that in just a little bit. But Adobe also had a downgrade today after a stellar earnings report. So Apple, like Microsoft, it succumbed to profit taking also. That was part of today's selling pressure. Even though Bank of America upgraded Apple to a buy from neutral. Adobe was downgraded to neutral from overweight at JP Morgan. So that's a reason why the technology sector was hurt pretty bad today. Now, the financial sector was up 0.6%. It escaped with a respectable gain amid an uptick in treasury yields today. Not a whole lot, but just a little bit. All right, so the S&P 500 is what you see on the chart here in front of you right now. And you can see that it did take a dip below its 21-day moving average today, but it is still up above its 50-day moving average. So in my opinion, it still looks healthy and it still looks strong. Let's hop over to Bitcoin, BTC USD on TradingView. And there is a link in the description for a free account to TradingView. Now, yesterday we were talking about this all-important 200-day moving average, and I am happy to report today that Bitcoin right now is up 3%. It bounced off its 200-day moving average, and it is now at 48,164. That 200-day moving average was all the way down to 46,842, and Bitcoin actually got as low as 46,300 today. So it slipped right below that 200-day moving average, but it has got a nice bounce going on right now. And if we look at Ethereum, ETHUSD on TradingView, look at Ethereum. Ethereum also has a green candle. It is up 1.2% right now. It's at 38.32. Now, today, it did come down to this ascending trend line right here, and it got as low as 36.86. Okay, so it's a couple $100 up above where it was there, just about. So for Ethereum, it needs to break back above 4,000. That's a critical point for Ethereum, 4,000. Back above that, and it still looks healthy. It would still be in this continuation pattern that it has been in for a couple months. Right now, it has broken below that. It's dipped below it. And when it gets back above it, right? Not if, but when, right? then it will look a whole lot better. The whole technical structure of it will look better. Now, Bitcoin, it's that $50,000 mark. It's going to be a struggle to get past it, but with the momentum it has right now, it has a very good chance of breaking above it. Now, I just want to say real quick before we dive into the individual stocks, if you like my perspective, then click the like button for this video. Number two, grab the URL for this video and share it on your other social media channels. Those two things are greatly beneficial and helpful to the channel. Third thing to do is, if you really do like my perspective on things, then click the first link in the description below for trade setup, stock ideas, and other exclusive content, including my popular top 10 growth, top 10 value that are updated constantly, and my top 10 momentum plays. It comes out every Tuesday evening for the week. And it's a great way to help support the channel, our research, analysis, technical breakdowns. So click that first link in the description. There's a plan for everyone. So thank you very much for listening to that for just a moment. Okay, Bath and Body Works. We've had that requested several times. BBWI. I'm putting them up on the chart here for you so you can see they have been nice and strong, trading above their 50-day moving average here for a while now. But Bath and Body Works, they coverage was initiated at a buy at Goldman Sachs with a price target of $93. So right now it's sitting at 72.88 in after hours. If we get, I have to pull this down a little bit here. So it's going to squish it up a little. Excuse me there. To get to $94. So if we measure from where we are right now in the after hours, and we go all the way up here to $93, that's a 27.5% upside in Bath and Body Works based on the buy rating from Goldman Sachs and a $93 price target. Okay, so a 27% upside there. That's really great, isn't it? Okay, CVS Health also had coverage initiated by Goldman Sachs today. CVS is the ticker symbol. We talked about them last week. They had spectacular news come out last week, and you can see that reflected in this nice tick up here. We talked about them probably when they were real close to this 50-day moving average here for them, that they bounced off nicely. They shot up here with earnings. They moved sideways, sold off a little, but bounced on that 50-day moving average and had a really nice rally. Now, when Goldman Sachs came out with a buy rating for CVS, they have a price target of $121. So we got to squish this up even more so we can get to that price point here. All right. So if we measure, now CVS last week, they announced a lot of cool stuff with what they're doing. So if we go from $98 and we're going to go up to $121 right there, that's a 22.8% upside. So that's a nice upside for CVS Health, right? I think it is. So looking really good. All right, the next one up that I want to talk about is Callaway Golf. Now, we talked about them in yesterday's live stream. Ticker symbol is ELY. Now, when we talked about Callaway yesterday, there was news coming across the wire that they were going to do a share buyback program. I believe it was $50 million. But Goldman also initiated coverage on Callaway Golf today with a neutral, so not a buy, this would be a step down, a neutral rating and a price target of $29. So it believes that it's almost fair value right now. So $29 is just a couple extra bucks. Measuring that, it's not going to be much from where it is right now. We go from $27 and we're going to $29. That's going to put upside potential at 7%, which would still be below their 200-day moving average there. You can see this thing has been, let's fix the chart. This thing has been in a downtrend, but it's had some pretty consistent tops and bottoms here. If we put a trend line on this, it'll look something like this. Remember, you want to get as many touch points as possible here. There we go. And then if we clone this, so we get the exact same angle, and then place it on the bottom. And again, you want as many touch points as possible to be consistent. You can now see the downtrend that it's in a little more clearly. So the golf business is on fire. It's a hot market right now. Everybody's out playing golf. The downside, and the reason why I believe they went to neutral, is because we are in fall going into winter, right? There's not that many people out playing golf in the northern portion of the US during winter. So I can understand the neutral rating. Of course, further south you go, then the more golf clubs are even open. Sometimes they close for the winter up north, especially way up north. So that's Callaway Golf. They're going to have an awesome spring when things get back to being open for them. So they're not a buy at this point, but they're one to keep on your radar. That share buyback program will do a good job to help the stock appreciate over the next quarter or two. So that's Callaway Golf. All right, let's quickly talk about, before we do our deep dives, let's talk about some signs from the market today. So there were a couple of names in today's top 20%. Now, in the consumer discretionary category, we had GameStop, GME for GameStop. They were in the top 20% for consumer discretionaries today, up 7.9%. You can see they have been trading in this channel right here all year long, but yesterday they dipped below it. Yesterday was a bad day for GameStop, AMC. They both were down. GameStop was down nearly 14% yesterday, and that took them out of their trading range here. But every time they dip below it, just like when they dip or go out above it, they always come right back into it. So back here in May, it dipped out of it, it came right back into it. Again, back here in April, it dipped out, it came back in. And then the biggest one was back in March when it dipped out and then came back in. So I suspect that GameStop is going to get back into its channel here and continue on. Now, I don't know how much pressure GameStop would be under based on what the Fed decides to do tomorrow. But do keep that in the back of your mind for all of your trade setups and so forth. All right, Dave & Buster's was another one. Ticker symbol is PLAY, PLAY. Now, Dave & Buster's was up 6.5% today. They're also in a trading range right now. They were in a downtrend, and then really they entered this range back in the beginning of July, and they're trading in it, but they've been staying towards the top. It's like they want to break out. They want to go higher. But every time there's a new fear of a new variant, it just puts a lid on how far they can go, because they just can't make money if they're not at capacity, right? Just like any type of company, if they're not at capacity, then they're not making much money. All right, let's talk about a few of today's top 20% losers. So in information technology, We had a bunch of them, and several of the names we've talked about here on the channel before. First one is Zscaler. Ticker symbol is ZS. They were down big today, 7.8%. Now, they were down more, over 10% earlier today. So there was a bit of a buy the dip this afternoon compared to how far things were going this morning. So that is a positive sign. Now, for Zscaler, it dipped out of its trading channel due to earnings, which weren't too terrible. But then they were making this comeback, and they were using this kind of steep support line here. But they have just fallen out of that. The candle is now down below that, way down here at the $283 a share mark. Now, Zscaler was downgraded today to underweight from neutral, meaning they're going, the technology sector as a whole is going to outperform a Zscaler. That's what underweight means. Neutral would mean it's going to move right along with the tech sector. So JP Morgan did that, which they also cut the price target for the stock to $320, which is still a really nice a gain from where it is now. If we measure that from where we are right now at close, which would be here, and we go up to $320, that's a 13.8% gain. So not too shabby, but that does not put them back up into their channel at 320. For them to get back into their channel, they're going to have to get closer to $350 to get close to that channel again. So we'll see about that. Datadog was also hit today. DDOG, DDOG. Datadog was hit with a downgrade today to neutral from overweight. So not as bad as Zscaler, but still a downgrade nonetheless, from JP Morgan with a price target of $195. So if we measure where we close today, which would be right about here, to $195, that would put us at about 21%. And that would put it back in its channel. I don't have the lines drawn here. I should do it. But that 21% gain would put Datadog right back into its channel real nice. If I scrunch it up there, we go back to their earnings in May, we can draw the lines there, the trend lines for its channel, which would look something like this. You want as many points as possible, okay? And then we clone that and go to the other side. And it's not going to be that low. It's going to be a little bit higher. Right about there. So that $195, that would put it up here right about midway of its channel that it's in right now. So that's not a bad move. 21% again for Datadog, potential upside for them. Now, Adobe, poor old Adobe, we talked about them after their earnings came out. They had a good earnings, ADBE, for Adobe. I like Adobe. It is an expensive stock, to say the least. But Adobe was downgraded to neutral from overweight by JP Morgan. And they put a price target of $680 on the stock. So if we measure from where we close today up to $680, that would put us at a 10% move. And that 10% move would really put Adobe on the high side of their continuation pattern that they're in here. They're just moving sideways. So they're not really in an uptrend, downtrend. Right now, they are moving sideways. They were in an uptrend. And then that broke here in September. They had a really bad September, but they rallied in October. October was a great ride for Adobe, but they fell out of that. And then another one is SolarWinds, SWI. Of course, they were in the news earlier this year from a hack. But SolarWinds, it's way down here. Let me fix the chart to make it a little easier. So they're way down here with their volume candles. That's how low they are at $13.90. But they were downgraded to neutral from overweight by JP Morgan with a price target of $16. So another 2.5, maybe 2.10 cents, right? Before it gets back up to that point. So not a big mover there for SolarWinds. Okay, now onto an industry that I absolutely love. I love the solar industry. But the solar industry got hit pretty hard today. If we look at Sunrun, RUN, run for Sunrun is their ticker symbol. I really like Sunrun. I think it's a great company. They were down 15.7%. They got down to a new 52-week low. A 52-week low today for Sunrun, and a big loss. They're now down to $35.50. This company was at $100 not too long ago. Well, I guess it is now. A year ago, right? Back in January, it was at $100 a share. Now it's down to $35. Let's look at one more, and then I'll tell you why these solar stocks fell. SunPower is another one. Ticker symbol is SPWR. SunPower was down 10.7% today. This is one we've talked about here on the channel. And somebody asked me about where's the support resistance levels for SunPower. And they've really been trading in these two channels, this upper channel up here, and then this lower channel. It fell into that lower channel today. It's down to $21.19. And then you have SunNova as well, who got hit. But the solar industry in general, it underperformed in the light of the California Public Utilities Commission's proposed changes on incentives for the state's net energy metering program. Even the solar ticker symbol, or ETF, TAN is the ticker symbol, of course, got hit today as well, because ETFs are just baskets of stocks as well. However, when you look at the individual names being hit 15%, 10% or more, the solar ETF, TAN, TAN, was only down 3.8%. And it's still in its trading range, even with that news. But it is showing relative strength weakness in the market. The RSI is down to 32. And remember, 30 and below, that's your oversold territory. So it's not quite there yet, but it's getting close. So that's what's going on with the... Hello, Carlos, how you doing? Okay, so yesterday, when talking about banks, I mentioned the regional bank ETF. The ticker symbol was KRE. I want to put that in here today. It's the Spider S&P Regional Bank ETF. I said this is going to be one that's going to overperform over the next 6-12 months. Well, today it is showing relative strength in the market, right? So it's looking really good. It's looking healthy. It needs to get back above that 50-day moving average, though. And once it does that, then I think that's when this stock, or ETF, I should say, can really move. But until then, it's going to be a little on the slower side of things. But once it gets back above the 50-day moving average, and I really think it's going to, especially once the rate hikes are realized, that's when the banks, especially the regional banks, are going to overperform. All right, just to share, I made my best day of 2021 today with Lucid. Oh, cool. LCID for Lucid. We talked about Tesla being down. Lucid was up 4.3% today. Back above that $40. Now, we talked about Lucid yesterday. I wouldn't be surprised if it dropped down to 30 over the next several months here until we can get confirmed how many deliveries did they make. But they are right now bouncing on that 50-day moving average, which is a good and positive sign for Lucid. So as long as they can keep that up, they'll continue this continuation pattern of moving sideways and just building up some momentum there. So that's cool, Carlos. I don't know what to buy tomorrow. Maybe what's that? KRBN. KRBN. Yeah, tomorrow's going to be a weird day. Carbon Strategy ETF. Okay, that's interesting. It is showing a good relative strength, although it has the relative strength's been easing on this one. It is above that 50-day moving average. That's a positive. Above that 21-day. But tomorrow is going to be a tricky day because the Fed can literally come out tomorrow and say a couple of words, and it will put a lot of selling pressure on the market. Tomorrow's market, whether up or down, green or red, is totally going to depend on what the Fed says. What does Jerome Powell say? What does the memo say that they release to the press before they give their press conference, before Jerome Powell speaks? What's in it? What's their timeline for rate hikes? Everything that they're going to talk about tomorrow can affect the market. It can affect it in a positive way, a negative way. It can affect certain sectors positive, other sectors negative, to kind of split the market. There's really all kinds of different things that the Fed could say tomorrow that will move the market in different directions. So tomorrow's an iffy day. Tomorrow is not like a day where you can count on your investment thesis. You can count on technical analysis. You can count on your trade setup for a particular stock, because the Fed could just come out and wreck all of that. So tomorrow is a tricky day. So just be careful with tomorrow and what the Fed may talk about tomorrow. There's a company that I talked about in last week's Catalyst Watch video that I've been watching. I've been waiting for. I owned it, and I was just waiting for the SPAC deal to close. Well, it did close last week. The stock made a nice 30% move. The company is Boxed. The ticker symbol is BOXD. Now, Boxed is like a Costco, but there's no warehouse you go to. You just do it on your phone, and they ship it to your door. So the SPAC deal was completed. It was completed back here. I got the tag there for it. Well, today for Boxed, they provided Q3 operating metrics. Very interesting for them. So this gives us a little insight into the company. and they were up 2.9% today. Now, they reported that their revenue rose 20% year over year to $49 million. And their average order value, or AOV, was $117 in Q3. That increased by 9% year over year. And the average order value a year ago was $104. So that's ticked up a little bit. Now, gross margins also rose, and they rose quite a bit, from 25.8% in Q3, and that's up from 16.9% from last year. So they really rose their gross margins. So that's pretty cool box to release that information up front before they have any earnings, just to give investors a little idea of what's happening with the company. So those numbers looked good, but of course, they're not going to release numbers that look bad. So that's kind of a given there. As you can see, when the announcement or when they finalized the SPAC deal and they voted on it, they had a big run, 30% plus day. And then they sold off 16% and 3%. And then today they've got the nice 2.9% bounce. So it was a good trade to be in. Anybody who watched the Catalyst Watch video and profited off of that, congratulations. Glad you did, because it's a cool company, and it's one that maybe you could put a couple shares away to hold on to for the next 5, 10 years, because I think the company is going to do really, really well. All right, let's get into a couple of deep dives here. First up is Uber. Ticker symbol is UBER. Now, Uber doesn't sound like it's too exciting, right? It's a company that's been around for a while. They've gotten up to a 52-week high of $64. And right now, they're really, really close to their 52-week low of $34.88. Right now, they're sitting at 37. But they came out with good news today, and they were up 4.2% during regular session, and they're up 0.5% in after hours. But really good news for Uber today. Now, during this morning's, I guess we could call it the UBS Investor Conference, Uber's CEO had plenty of good news to share. As a matter of fact, he highlighted with his remarks, and he also said that the last week, the full week, was the company's strongest week ever in terms of overall gross bookings. So how many riders they had for the entire week and how much money they made off of those rides. Best week ever. And later on, and I'll talk about this, but he mentioned how he believes the stock is undervalued. I mean, how can a company go to having its best week ever to be down near its 52-week lows, right? Something doesn't add up there. Is the market missing the beat here on Uber? I guess it's a possibility, right? But the bullish update is obviously a welcome sign for investors. The rideshare leader, and of course its smaller competitor, Lyft, and their ticker symbol is LYFT, each of which have experienced their stocks declining 20% or more since the beginning of November. It's just been right down for them. Concerns over the variant have popped up, and that has impacted rideshare demand. In addition to fresh regulatory concerns from the EU, that's also battered shares of both companies. It's the last thing you want. You don't want ridership to go down because people are scared of one aspect or another with the different variants. And you don't want regulations coming down preventing you from doing business. So, at least for the time being, Uber's CEO did have encouraging comments that really eased investors' anxiety. In regards to the regulation, remember back on December 9th, the European Commission, it announced a draft that would put rules in place to provide for drivers for these online companies like Uber with employee benefits. While the proposal, it's not law yet, and the final outcome will likely be hashed out on a country by country basis in the EU. This latest development put regulatory risk back into the spotlight for Uber and Lyft. Unsurprisingly, the EU action was a key topic of interest during this morning's USB conference. As Uber's CEO took questions from the audience there were questions about the possible impact of regulation in the EU, and Uber CEO expressed confidence that the end result would be quite manageable for Uber. Specifically, he believes that the independent contractor plus model, that's their model that Uber is putting forth, the independent contractor plus, okay? That model that Uber is pushing could be a win-win for the authorities, for Uber, and for Uber's drivers. Adding that this is Uber and what their CEO is thinking. He believes that the vast majority of drivers want to be classified as independent contractors. They want that independence. And under this model of independent contractor plus, drivers are not guaranteed the range of benefits that full-time employees are provided. But there are certain protections in place, such as minimum earnings and other benefits, such as pensions and bonuses, may also be offered in the independent contractor plus kind of idea. Another key theme from the meeting is that Uber's CEO believes that Uber is significantly undervalued. This sentiment is at least partially based on his view that Uber is in a much stronger position, is a much stronger company right now compared to when it went public back on May the 10th, 2019, with the stock trading about 17% below its $45 IPO price, despite the fact that Uber is now profitable on an adjusted basis. The undervalue assertion may have a little bit of merit. For a little bit of context, in Uber's IPO investor presentation, Uber estimated that its adjusted earnings before taxes, etc., for Q1 19 would be a loss between 954 million to 847 million. Most importantly, though, Uber CEO didn't just verbalize his convictions, he backed them up by purchasing $9 million worth of Uber shares in November, just last month. So he's basically putting his money where his mouth is, right? That old adage. So he clearly likes what he is seeing in current trends on both sides of the business. Because remember, you've got Uber Eats as well. So you've got mobility, transportation, and then you've got delivery with fast food and so forth. So in mobility, wait times and driver supply continue to improve, which bodes well for margins. The delivery side is also coming off its best gross bookings week ever, illustrating that the acceleration in demand generated from the pandemic has staying power. That growth is turning into profitable growth too. As Uber reduces its cost per transaction, and as member customers become a larger percentage of the total mix, at the same time, this improving profitability profile is allowing Uber to invest in new growth opportunities, such as grocery delivery and geographic expansion. I know that DoorDash is expanding rather rapidly as well with new investments in grocery delivery, and I think they even deliver Christmas cookies across the United States now too. So that's something to watch out for, Uber. But the main takeaway is that business for Uber right now is strong, and it's strong for mobility and its delivery segments, indicating that concerns regarding the Omicron impact on Uber and Lyft, they may just be overblown. But what do you think? Do you think Uber is undervalued and it's really worth more? And can we trust that the CEO of Uber buying millions of dollars of shares and sharing with the world that they have had their best week ever as a company? I think we can. Otherwise, there would be a investigation by the SEC if those claims were untrue. So I think we can put a lot of credit behind Uber's CEO and what he said and what he's doing by purchasing the shares of Uber. So this downtrend that we see for Uber, it may just be about to change and start to reverse trend. But time will tell, of course. But let me know, though, what you think. I really want to hear from you. Is it undervalued to the point that, man, this could be seen as a value play and not necessarily a growth play? Even though the company is a growth company with the share price so discounted, again, it's just a couple dollars away from its 52-week low. Do your due diligence, look into it for yourself, and see if you agree or not with the CEO's comments and my commentary on Uber. Okay, there's Uber for you. Let's go to another company. More, I guess we could say this is a more wholesome, hearty company. Campbell Soups. Ticker symbol is CPB. Now, I know, I don't talk about the sexiest companies out there. I don't talk about the most popular companies out on YouTube. I know I don't do that. I talk about the companies that have, in my belief, either staying power, meaning you can go ride the fastest company out there, you can go up 40% in a day and drop 50% the next day. You can go on those wild rides if you would like. I'd rather find companies that go up and to the right on the chart for long-term investors. So now I'm talking about Campbell Soup. It's not the funnest company to talk about. I mean, they literally make cans of soup. But it's a company that, looking at the stock chart here, it's seen better days, right? It's also a company that's been around for a while, and it's also a company that I know we don't talk enough about, but it pays a 3.39% dividend yield. And if we look at this stock chart, I mean, as I keep scrunching it up here, getting another year and another year and another year in here, this is what it looks like going back to the end of 2013 until today. I mean, this thing has seen peaks, it has seen valleys. I mean, look at this top peak up here is at $68, right? It's now down to 43. And then we go to this valley down here, and we're getting down to $32. So we're only, what, $11 away from that bottom there. So we're not talking about big price movements, but percentage wise, if we go to where it closed today to this all-time high here of 68, well, that's a 57% difference. So right now, Campbell Soups, it's over 57% lower than it was in August of 2017. But the whole reason I bring Campbell Soups up is there was some news about Campbell Soups. They had earnings last week. Let me put a vertical there. I always like to mark out where earnings were. They helped to show us on the chart the whoa, that's not what I wanted. They helped to show us on the chart how the company tends to act around earnings. But for Campbell Soups, they should have drinking a V8. Its stock is trading relatively flat. It was down 1.3% today, after the company reaffirmed its fiscal year 2022 guidance. The canned soup and consumer food and beverage giant that owns brands like V8, Goldfish, and Pepperidge Farm just posted Q1 earnings last week, at which time it also outlined its fiscal year 22 outlook and long-term guidance. As such, given that investors wouldn't have anticipated or expected much to change in just a single week, the reaction to today's reassurance is perhaps unsurprisingly muted. What may be more surprising, however, is that Campbell Soup shares have fallen about 10% on the year, while shares of many of its competitors, such as General Mills, ticker symbol GIS, JM Smucker, ticker symbol SJM, Kellogg, ticker symbol K, and PepsiCo, ticker symbol PEP, are all up year to date. Campbell Soup, well, it trades at a similar valuation to those companies at 50-50 at 15.5 times fiscal year 22 earnings, and also provides investors with a comparable dividend yield of 3.4. Why is the stock struggling to gain momentum? The main reason is shortages. Campbell Soup posted a 4% decline in organic revenue year over year in Q1, missing estimates primarily as a result of labor constraints in-house. And while its suppliers, along with raw material shortages, particularly regarding aluminum cans and specific ingredients, those headwinds impacted Campbell Soup's meals and beverages and snacks segments and pressured Campbell Soup's market share in the affected categories. As a result, Campbell Soup guided to roughly flat organic net sales growth in fiscal year 22. Campbell Soup's competitors are not immune to similar headwinds either. For example, GIS sees significant supply constraints across its dessert line, with minor ingredient shortages sprinkled across multiple product lines. It is also dealing with labor shortages, especially for truck drivers. SJM, K, Kellogg's, and PEP, Pepsi, each note similar issues. However, it appears that the competition is having more success navigating such issues, as each beat on revenue in their own recent quarters, while Campbell Soup missed analyst expectations in Q1. Campbell Soup's Q1 sales miss notwithstanding, certain trends are proving to be resilient. As an example, on a 2-year stack, total organic net sales were up 5% in Q1. For a company that has typically seen organic net sales decline or grow about 1% annually before 2020, 5% growth is quite impressive. In addition, the growth happened despite rising inflation and increasing mobility concerns. Campbell Soup noted that it retained its pandemic-fueled expansion in its consumer base in the quarter from consumers continuing to need quick meal preparation options as remote work accelerates. Looking ahead, Campbell Soup guided to organic sales growth of approximately 2% annually over the long term. Although this may seem like not much growth, right? Again, Campbell Soup was seeing essentially flat growth over the past few years leading up to the pandemic. Also, Campbell Soup is not considered a high growth stock, but rather viewed as mainly as a consistent dividend paying, selling consumer defensive products. You got that? That was a mouthful. Therefore, the company looks pretty attractive given Campbell Soup's solid valuation of 15.5 times forward earnings, its 3.4% dividend yield, and its long-term sales growth target. Furthermore, the stock's 10% dip year to date makes for a nice entry point for buy and hold investors. Well, there's Campbell Soups for you. What do you think about Campbell Soups? It's a dividend paying stock that doesn't really move that much. It's really been just a solid, steady growth absent, right? Dividend paying stock. But now you add in a couple percent in growth looking ahead, and maybe you got something here. Obviously, it's not for everyone, but it could be moving in the right direction to give you, in a very uncertain market, a place to park capital to earn a 3.4% dividend on that capital while the market freaks out. It's a possibility, and it's one I wanted to share, especially with the uncertainty in the market today. Okay, let's move on to something maybe a little more exciting. I don't know if you will find it that exciting or not, but let's do it. And remember, if you do have a question, leave that question in the comments with the ticker symbol of the company, and we will go over it. Okay. More than a year ago, Bloomberg reported that industrial conglomerate 3M, ticker symbol is 3Ms, reported that 3M was exploring the possibility of selling its food safety business. Yep, I knew it. Another boring type of company, right? Food safety business. Who wants to invest in something like that when we've got Teslas and Apples and Microsofts? I don't know, right? Like Campbell Soups. Give it a try. Maybe you'll like it, right? Okay. So they were thinking about selling their food safety business, which makes products that test and monitor the microbiology and the quality of food. Today, that possibility became a reality as 3M and Neogen, ticker symbol NEOG, entered into a definitive agreement through which 3M will spin off the food safety division and simultaneously combine it with Neogen. The mechanics of the transaction include a $1 billion payment to 3M, followed by a stock insurance by Neogen, resulting in $3 million gaining a 50.1% ownership stake in the new combined business. Existing Neogen shareholders will retain 49.9% of ownership of the company that now has an estimated enterprise value of about $9.3 billion after the addition of 3M's food safety unit. As a manufacturing of test kits that detect toxins, bacteria, and other harmful elements in food, Neogen is a competitor to 3M's food safety business. Therefore, This merger leaves the competitive playing field for Neogen while adding a sizable boost to its top line. In fact, the combined company's annual revenue is expected to nearly double to $1 billion, with the current version of Neogen projected to generate sales of $526 million for its fiscal year, which ends in May. It appears that 3M's food safety business is growing at a rate similar to, or perhaps slightly stronger than, Neogen's current mid to upper teen level. During 3M's Q3 earnings conference call, 3M CEO noted that food safety business increased by double digits as food service activity returned. Drilling down a bit further, using fiscal year 19's revenue of $341 billion for the unit and the estimated $474 million annual revenue contribution to the new combined business, I think we can surmise that the business is poised to grow by about 40% in the span of about 2 years, given that there's likely plenty of overlap between the two businesses in terms of supply chain, technology, and customer base. The opportunity to attain cost synergies is significant. Just look at Jack in the Box acquiring Del Taco. They're estimated to save millions of dollars in synergies. Following the combination of Neogen, we anticipate that the earnings before taxes and etc., that the margin will reach 30%. Although not a perfect apples to apples comparison of earnings before taxes and stuff, in fiscal year 21, Neogen reported income before taxes of $75.3 million, which translates into 16% of revenue. It's easy to see why Neogen was attracted to this deal. But some may wonder why 3M would be interested in spinning off a business that has performed well. Similar to other large enterprises that recently announced spin-offs, you got Johnson & Johnson, GE, even Harley-Davidson's. We just talked about that. They're spinning off their electric motorcycle segment, just to name a few. So 3M is looking to streamline and simplify its business structure. The timing to execute this deal is also in 3M's favor, as the valuation of its food safety business has risen sharply. When that Bloomberg report hit on September 22nd, 2020, it was estimated that the division would fetch about $3.5 billion, more than 10 times fiscal year 19 sales. As it turns out, that estimate is quite conservative, as the transaction with Neogen implies an enterprise value of $5.3 billion, including $1 billion in new debt. In essence, 3M accomplishes its goal of trimming down the business just a bit while also cashing in on a strong business that accounts for a tiny fraction of its overall sales. The main takeaway then is that this deal looks like a win-win scenario for both companies, as reflected in today's gains for each stock. So what do you think about this interesting story from 3M, its food safety business, spinning it off to be included with Neogen? Let me know in the comments whether you like these types of stories about companies or not. I found it quite interesting. But you may have a different opinion. I know this was a different take on a stock. Usually, when I do my deep dives, I'm talking specifically about a company, how it's improving or not improving. But this time, it felt more like a story about a certain stock and another stock and those stocks getting together. Let me know if you like that or not. And if you found this video to be helpful, informative, actionable, then there's 3 things I would love for you to do. Number 1 is to click the like button. Just take a quick few seconds, click the like button to help reach more people, right? Number 2, take the URL and share it across your other social media channels. Why would I ask you to do 1 and 2? To like this video and to share the URL? To help other people reach financial freedom. That's all it's about. And the third thing is, if you really like my perspective, then click the first link in the description and you can find a Patreon plan or tier that works for you. There's trade setups, trade ideas, top 10 lists for growth stocks, for value stocks, top 10 list for momentum stocks, buy sell signals, all kinds of neat benefits. But most importantly, it helps to sustain our research, our analysis, and our technical breakdowns. And it also allows us to reach our goal of hiring more writers so we can give you the best information at the right time to help you make the right investing decision. That's what it's all about. Financial freedom and letting you have the information. Okay, the last thing that I want to dive into right now is catalyst for tomorrow. So I posted on our website, tickertimenews.com, the catalyst for this week. Tomorrow's catalyst is right here. This is it. 2 things. Number 1, what is the Fed going to say? That's it. Whatever the Fed says, that can move the market in one way or another, up or down, green or red. It can also move certain sectors in different directions. It could potentially move financials down if they push tapering or rate hikes back further. If they're pulling rate hikes up ahead of schedule, then the financial sector will go up. And then, of course, growth in tech will go down. So whatever the Fed says tomorrow, it's going to move the market in one way or another. And nobody can say for certain what the Fed is going to do. So we just have to be patient and be prepared. Now, the next thing that's happening tomorrow is Lunar. Ticker symbol is LEN. And I'll go here and put the chart up. LEN. They're a home builder, right? Now, Toll Brothers reported earnings last week, and they came in with excellent earnings. As a matter of fact, TOL is Toll Brothers stock chart, and you can see right here they popped way above out of their channel based off of their earnings, and of course they're coming back down now. Of course, you know that's what happens. The faster stock goes up, the faster it comes down. So when you're on a ride like this, you sell at the top. This isn't where you want to buy and hold for the long term. You want to buy and hold down here at the bottoms, right? So they did really good. So with Toll Brothers doing good, that should be a good sign for Lennar also doing good. But there is a distinction between the two companies. Toll Brothers, who's already reported earnings, they build more luxury homes. So their margins are a little bit higher. Lennar doesn't build those luxury homes like Toll Brothers, so their margins are a little smaller. Okay. Now, Toll Brothers, their average selling price is $900,000 a home. Lennar, on the other hand, their average selling price is $500,000 a home. So you can see the difference there. Even if they sell the same amount of homes, Lennar is going to have less revenue and smaller margins. Okay. Now, the other thing to keep in mind is since right here, let me put a circle around it. This is when earnings came out for Toll Brothers. Okay. So look what happened to the stock. It ran up. So the question is, are tomorrow's earnings already priced in? That's the big question. They could be. Now, they are reporting an estimated EPS or earnings per share of $4.16 on revenue of $8.51 billion. So that's what to keep in mind for tomorrow. For Lennar right there. Ticker symbol is LEN. Now, on Thursday, we've got a whole bunch of things to watch for Thursday. We could get some really big moves on Thursday because what the Fed's doing will be behind us now. And then these certain catalysts that we're watching for Thursday will be in front of us. So I'll go through this just real quick. Tomorrow, I'll go through this a little bit deeper. So we have Rivian Automotive. They report their earnings for the first time. Expensify, they report their earnings for the first time. We got Delta Airlines hosting a capital markets day where they're going to share their long-term earnings and margin targets, as well as a plan to restore the balance sheet because COVID has crushed that. Alibaba, whether you want to see it as a value stock or a stock to stay away from, wherever you fall on that, Alibaba does host a virtual investor day, so that could be interesting. Pre-market on Thursday, Accenture, they post their earnings. We have Juniper Networks. They're hosting a 5G tech talk. Now, 5G is a hot topic. And then we got Adobe on Thursday, pre-market, posting earnings. And they were hit today pretty hard because of a downgrade. So that could be setting up a nice move for Adobe. All right, that's Thursday. And then Friday, real quick, we got Darden Restaurants reporting earnings. We got Winnebago reporting earnings. And Thor, the competitor to Winnebago, they just blew out their earnings. And we also have NEO hosting NEO Day 21 on Saturday, local time for them. And then on Saturday, the NASDAQ 100 will have completed its rebalancing that it does every year. Companies that are being added to the NASDAQ 100 include Airbnb, Lucid Group, right? Fortinet, Palo Alto Networks, Zscaler, and Datadog, who were both downgraded today, but are being added to the NASDAQ 100. Were they downgraded, Zscaler, Datadog, were they downgraded today so those who have to purchase their stock for the different ETFs that track the NASDAQ 100 so they could get a better price? Not saying that happened. No. But it was a quick idea, right? Okay. Well, if you have no other questions, ladies and gentlemen, I will leave it here for tonight. And I will be back in the next video. Remember, if you are watching the rerun of this, right, then you can leave the ticker symbol and your question in the comments, and we will go over it live during the next live stream, which is tomorrow around 5 p.m. Eastern. After that, I do have a video coming out later this evening, and one or two tomorrow as well. So thank you for joining me. Make sure to do 3 things. Click the like button, number 1. Number 2, share this video everywhere. Take the URL, go to Facebook, go to Twitter, go to Instagram, wherever it is, and share it. Number 3, click the first link in the description if you like my perspective on the world, the financial markets. There's a plan for everyone. First link in the description. And also, if you go look in the description, you'll find some cool things. Like if you don't have a Webull account yet, you can click the Webull link. You can get a few free stocks, a couple free stocks, I should say, and then close the account if you want to. It's free money. Why not get free money, right? All right, so do those things, and I love you guys. I will see you tomorrow for sure. I love the questions. I love the conversation. I love everything about this. Okay, ladies and gentlemen, thank you so very much for watching, and I will see you in the next video.